Did you know the housing market could face a significant depression soon?
That's the talk. Experts are raising alarms, highlighting data that could shock us. Stay tuned to discover what leading analysts are saying across stocks and commodities.
Welcome to Financial Insights in Minutes. We summarize critical financial news, empowering you to stay informed.
Let's dive into the insights from today's most pressing financial videos. First, MHFin dissects indicators of a housing market downturn that's looming. Next, Eurodollar University sheds light on troubling economic data recently released. David Lin forecasts the potential for ongoing momentum in gold prices. What to watch next? The technical traders analyze sentiment shifts, signaling a pivotal market point. Mike Harris discusses strategies and risks involved in quant trading approaches. Jason Shapiro offers strategies for traders grappling with loss of market edge. Finally, Bob Elliott argues how upcoming elections can be viewed as significant risk management exercises.
Welcome to MHFin, where today we're diving deep into the brewing concerns around a potential housing depression. We've got insights from none other than Robert Shiller, a titan in economic theory and real estate analysis.
That's right. Shiller's analysis brings a historical perspective that provides crucial context for today's market. Buckle up as we navigate through significant economic waters.
So, what's the core message from Shiller's analysis?
The housing market is showing signs of a possible correction in specific areas, especially where prices have rapidly increased. This isn't just speculation. It's backed by historical trends and economic indicators.
First up, let's talk about those skyrocketing home prices. What's Shiller pointing to?
Shiller highlights that prices have soared by about 85% since 2019, resembling the unsustainable growth before the 2008 crash.
Let's unpack the price-to-income ratios next. How bad is the affordability crisis?
It's grim. Affording typical houses is becoming nearly impossible for average earners, a hallmark of bubble conditions.
And what about speculation in the market? What are we seeing?
We're looking at a significant resurgence in home flipping, with rates close to the highs before the last crash.
So, what does Shiller predict for the future of the housing market?
He cautions that current market conditions could lead to a crash similar to 2008, starting in the most volatile regions.
And what about the economy as a whole?
The economic landscape is tricky. Increased rates mean potential buyers will likely delay purchases, adding to market challenges.
So, what are the major takeaways from Shiller's insights?
In essence, staying informed about these trends is vital for anyone involved in buying or selling property in today's market.
As we wrap up, what are your thoughts on the housing market heading into 2024?
Let us know in the comments. Your perspectives could really shape our understanding of this unfolding scenario.
Welcome to Eurodollar University. Today, we're diving into the choppy waters of economic data with a focus on recent revisions that have left many scratching their heads. With us is economic expert Steven Van Meter. Get ready for a wild ride.
Absolutely. Today, we'll unpack what these revisions mean and why they could signal trouble for the economy. Buckle up.
So what's the core issue here? Why are so many economic indicators being revised downwards?
The central thesis posits that many economic indicators, like retail sales, are being reported higher initially, but are then revised lower, indicating that the economy is weaker than initially thought.
Let's discuss what's happening with these tragic revisions in economic data.
It's a phenomenon dubbed revision disease, where reports such as payrolls and retail sales are often found to be overstated after revisions. This leaves analysts questioning their accuracy.
What about retail sales? How exactly have they been affected?
Initial reports showed retail sales in July were strong, but they were adjusted to reveal that the situation isn't as rosy. Previous months were revised down even more.
And how does the industrial production data tie into this?
Industrial production was initially reported as negative. This was revised to show a contraction, which suggests serious underlying issues in manufacturing.
What does this suggest about consumer behavior?
The revisions indicate that despite headline numbers, consumers are not spending as much. This loss of confidence could spell trouble for future growth.
What predictions can we draw from all this?
The consensus is that if these trends continue, we might be looking at an economic slowdown, potentially signaling a recession ahead.
To wrap things up, what are the main takeaways from this discussion?
In summary, the revisions highlighted today show significant discrepancies in the economy's health, suggesting we should be cautious moving forward. Let's keep an eye on the trends, rather than one-off headlines.
We want to hear from you. What do you think about these data revisions?
Drop your comments below. Let's spark a conversation about the real state of our economy.
Welcome to David Lin's channel. Today's hot topic: gold prices just broke records today, soaring to $2,500. It's a thrilling time to dive into the gold market.
Indeed. Joining us is Gary Wagner, the expert from thegoldforecast.com. Let's get straight to the facts about this bullish trend.
So, what's the central message from Gary's views on the gold market?
The core thesis is clear. Gold is experiencing a strong bullish momentum, with current prices driven by demand, particularly from China, and favorable economic conditions.
Let's explore some key points. First up, the gold price. What's the latest?
The gold price just reached an all-time high at $2,500, with Gary maintaining a target of $2,700 by the end of the year.
And what about the driving forces behind this surge?
Consumer demand, especially from China, coupled with central banks stockpiling gold as a safe haven, is fueling this bullish momentum.
Now, let's touch on technical analysis. What's the story there?
Gary emphasizes that technical charts show a strong trend with no signs of weakness, indicating a robust market strength.
What role do politics play in this scenario?
Ongoing geopolitical tensions worldwide are making gold increasingly appealing as a hedge against uncertainty.
Now let's discuss investor behavior. What's changing?
Investors are viewing gold as a safe asset amidst economic uncertainty, leading to significant portfolio shifts towards gold.
Gary, any predictions moving forward?
Gary predicts that if current trends hold, we could see gold prices reaching $2,585 shortly.
What about the impact of upcoming interest rate changes?
If the Federal Reserve shifts towards cutting interest rates, it could drive gold prices even higher, benefiting the market further.
Wrapping things up, what should we take away?
The outlook for gold remains bullish as demand grows. It's a volatile but promising market to watch.
We want your insights. How do you see the gold market evolving?
Drop your thoughts in the comments below. Let's navigate these turbulent waters together.
Welcome to the Technical Traders. Today's topic: what does August seasonality mean for traders?
Right on. This video gives us some valuable insights into market cycles and the potential for upcoming turns.
So what's the core thesis in this analysis?
The speaker outlines the mixed signals in the market, hinting at the potential for an upward trend while cautioning about a critical market top approaching. It's all about timing the next entry perfectly.
Let's dive into the key points, starting with current market performance. What's going on?
Markets are showing a mixed performance. The S&P 500 and Nasdaq are slightly positive, while the Dow is lagging behind. Daily charts are hinting at a forthcoming upward movement.
Next up, what about the buy trigger?
There's a new buy trigger approaching. While volatility remains high, this could represent significant trading opportunities for eager traders.
And what about cycle analysis? Any warning signs?
Absolutely. The speaker warns of a potential major market top, drawing parallels to previous market conditions. It's a bit nerve-wracking.
What are the predictions about market corrections?
The prediction is for a significant market correction, potentially diving below 2022 lows. It's essential for traders to remain vigilant.
And gold, what's the outlook there?
Gold's looking strong. Its prices are likely to surge with positive momentum expected through the year. If you're into precious metals, now's a good time.
As we wrap this up, what are the takeaways?
Traders should prepare for both short-term trading opportunities and be mentally ready for long-term corrections. It's a balancing act.
And now we want to hear from everyone watching. What do you think will happen in the markets?
Drop your insights in the comments. Let's navigate these turbulent waters together.
Welcome to Blockworks Macro. Today's episode is a deep dive into the world of quantitative trading, featuring Michael Harris, president of Quest Partners. With 25 years of experience, Mike will guide us through the exhilarating waters of quant investing.
Absolutely. Michael's extensive background in hedge funds positions him as a crucial voice in understanding the intricacies of quantitative strategies and the market dynamics at play. Prepare for some serious insights.
So, What's the core focus of today's discussion?
We're exploring how quant strategies not only navigate, but thrive during volatile market conditions. Mike emphasizes their adaptability to ever-shifting market landscapes.
Let's talk strategies. Can you break down the trend-following method used by Quest?
Sure. Quest utilizes a short-term trend-following strategy, typically holding trades for an average ranging from 6 to 40 days, capturing momentum efficiently.
What risks are unique to quantitative trading?
High market volatility often unveils lucrative opportunities. However, the negative skew common in traditional hedge strategies creates significant systemic risks.
What role does technology play in trading today?
Technology is pivotal. Many firms, including Quest, are integrating AI and advanced machine learning for improved decision-making and trade execution.
Any predictions about market trends?
Expect increased volatility driven by geopolitical tensions, plus the heavy concentration in major technology stocks could set the stage for market corrections soon.
What are the main takeaways from today's discussion?
To thrive in quant trading, it's crucial to grasp the market dynamics and integrate versatile strategies to effectively manage inherent risks.
As we wrap up, what strategies do you believe will shape the future of trading?
Drop your thoughts in the comments. We want to know how you see the landscape evolving.
Cup of the morning. It's Saturday, August 17th, 2024, and welcome to Crowded Market Report, where we dive deep into trading strategies. Today we're focused on a crucial topic: what to do when the trading edge is as elusive as a mirage in a desert.
Absolutely. Jason Shapiro guides us through the turbulent waters of trading discipline today. He's got the experience and insight to keep us afloat, especially when the market has other plans.
So what's the crux of Jason's message here? What's the big idea?
The key takeaway is straightforward. Don't trade without an edge. Even if you're tempted to jump in, waiting for the right moment to strike is where successful trading is built. Patience pays off.
Let's delve into Jason's first key point about trading edges. What's he saying?
Jason emphasizes that to succeed, you must first identify your edge, whether that's through trend following or counter-trend trades. If the market isn't aligning, it's time to sit tight.
How about this patience concept? Why is that so vital?
Trading without the right edge is like fishing without bait. It's important to avoid those impulse trades that could bite back. Patience helps preserve what you've got until a solid opportunity arises.
And what's Jason's advice about readiness to trade?
He stresses the importance of doing your homework. Only trade when market conditions align with your strategy. That way, you'll be ready to strike when the perfect opportunity arises.
What predictions does Jason make about market behavior?
He believes new market trends often emerge, so patience might just reveal the next edge. That psychological aspect of trading cannot be overlooked.
Interesting. What about challenges stemming from trading psychology?
Jason warns that long stretches without trading can lead to doubt. Stay disciplined and remind yourself of your strategies to offset that urge to jump in.
To wrap it up, what's the magic formula for successful trading?
Patience and discipline. Jason underscores the importance of understanding your edge and waiting for the right moment. So, fellow traders, remember, don't rush in when the waters aren't clear.
Before we go, we want to know, what trading edges do you focus on?
Let us know in the comments. Your insights could help fellow traders navigate these tricky waters.
Welcome to Bob Elliott's channel, where today we're diving deep into a compelling topic: how elections serve as risk management exercises in the economy.
That's right. We're breaking down how the intersection of elections and fiscal policies impacts market dynamics. Buckle up.
So what's the key thesis here?
Elections aren't just about who's winning. They're significantly about managing risk, since political outcomes can be unpredictable, influencing fiscal policies.
Let's unpack the first key point, stressing how uncertain political outcomes are.
Exactly. The reality is, no one truly knows the outcome until it happens. It's like trying to see through fog.
How should one navigate the confusion then?
Focus on the policies that will be implemented. It's much wiser to analyze laws after they're passed instead of speculating.
What's this about risk management?
Elections should be viewed more as risk management exercises. Expect unpredictability.
What predictions arise regarding new policies?
Policy implementation post-elections will significantly impact the economic landscape. Strategy will matter.
And what about the uncertainties?
Many potential policies can emerge, but trusting the process is crucial. Let results guide decisions.
To sum up the major takeaways,
Elections are crucial for risk management, showcasing how dynamic political landscapes impact our economy.
as we close, what are your thoughts on election-driven risk management?
Share your insights in the comments. Let's get a conversation going.
Today's discussion revealed profound concerns from our experts about the housing market and economic stability.
Indeed, the varying perspectives highlight significant risks while also emphasizing gold's growing potential.
Our analysts urge caution, especially in quant trading and when navigating market sentiments. If you'd like more time-saving content, please remember to like and subscribe. Thanks for watching Financial Insights in Minutes for August 19th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.